The Stroh's fortune collapsed. How did this happen? A $1.7 billion value loss began with a single procurement decision. Schlitz, once the world's #2 brewer, switched to a cheaper protein stabilizer called ChillGuard. The promise on the procurement memo was clear: equivalent performance, 12% cost savings. The consequence was immediate and catastrophic. Schlitz was a global powerhouse. Deep distribution, entrenched retailer relationships, tight margins in a mature market. Management faced pressure to protect margins and show quarterly savings. The Strohs acquired Schlitz and took on debt to finance that acquisition. That leverage made every percentage point of margin material to family balance sheets. Procurement approved ChillGuard to lower ingredient costs. Plants implemented the change. At first, it looked like a win. Cost reports improved. Bonuses stayed on track. Frontline managers celebrated smoother runs. Procurement teams won praise. Momentum built around the savings. The Stroh's financial models showed the acquisition paying down debt faster with these efficiencies. Then warning signs appeared. Within weeks, sporadic alerts hit quality control, occasional turbidity, and tiny protein flakes in limited runs. Internal lab notes flagged an unusual aggregate under stress tests. The anomalies were intermittent, and the numbers on cost savings and production volume masked urgency. Small returns were logged. A few grocery chains removed affected lots from shelves. Finance recorded small sales dips in key markets. Risk rose, but it still looked containable. Local workers and store staff bore the early human strain. Delivery drivers answered angry calls. Store managers photographed bottles and logged complaints. Customer service teams were overwhelmed. Frontline workers faced public blame and mounting stress. The company's immediate losses were still recoverable until they were not. Independent lab results confirmed what internal notes had only suggested. ChillGuard formed insoluble protein aggregates under certain storage conditions. National accounts began to distance themselves. Several regional buyers paused orders. Risk moved from local to systemic. Returns turned into delistings. The balance between cost savings and enterprise risk inverted. A viral consumer video changed everything. A high-profile influencer opened a boxed case and revealed flakes in a bottle. Retail delistings accelerated. Major distributors issued holds. Credit lines were re-examined. Lenders who had underwritten the Stroh's acquisition now watched inventory pile up and invoices go unpaid. Each development increased pressure. Each development deepened the financial hole the Strohs were already managing. Regulators and consumer advocates launched formal inquiries. Long-tenured quality staff who had raised concerns were sidelined or left. Executives who had championed the ChillGuard switch now faced public reputational fallout. Legal liabilities and remediation costs ballooned. Revenue collapsed. Stock plunged. Lenders called covenants. Within months, Schlitz declared insolvency or sold its assets. The $1.7 billion in market value evaporated. The company's corporate identity fractured. Institutional fallout followed. Settlements, plant closures, and renegotiated lender agreements. For the Strohs, the collapse translated into personal financial disaster. The debt used to buy Schlitz magnified the market loss into severe family losses. Retirement security tied to the family holdings diminished. Long-term investments were repriced or sold. The dynasty value that had seemed stable was stripped away in a few sharp moves. Thousands of jobs disappeared. Decades of brand trust were gone. Competitors absorbed market share. Industry governance tightened around supplier validation and procurement oversight. A forensic economic review later exposed the cascade. It showed a clear chain. A single procurement decision created systemic quality risk. The balance sheet saved a small amount on inputs. It lost far more in intangible capital, trust, distribution partnerships, and workforce stability. The cleanup costs, settlements, and lost future earnings exceeded the earlier savings many times over. Stay with this story. The human cost was deep. Workers lost wages. Managers lost reputations. The Stros lost the leverage of a once profitable investment and much of the wealth wrapped around it. Regulators changed industry practice. Boards reviewed procurement governance. The market demanded stricter validation for supplier changes. Companies now treat equivalent cost language with new skepticism. The immediate consequence was insolvency and asset sales. The long-term consequence was a reset in how industry balances cost with quality and a cautionary recalibration of corporate risk tolerance. The fall of Schlitz shows how fragile dynasty value can be. When short-term margin decisions override quality safeguards and governance, the hidden costs, lost trust, disrupted livelihoods, and wiped out fortunes far exceed the savings on paper. The key mystery remains a warning. How often do we let a single spreadsheet row threaten an empire? Learn the warning signs.